Every bond has special terms and conditions stipulated in the bond prospectus, these documents. Kenyans are used to long-term bonds with only one redemption date, and the redemption date is when your principal amount will be paid back by the Central Bank of Kenya. For example, an 18-year bond issued in 2022 where your principal amount will be paid back in 2040. But the November 2022 infrastructure bond has special terms and conditions, has two special terms and conditions that people seem not to understand, and I've been receiving numerous questions from the Wealth Tribe. You need to understand these two terms and conditions before you invest. And the two conditions are the redemption structure and the amortization. The redemption structure simply answers the question, when will your principal amount be repaid? And the bond amortization is the gradual or regular repayment of the principal and the interest of the bond in the course of its life. It's simply the process of repaying back a debt using regular repayments. You know that a bond is a debt instrument, right? A bond is simply the government of Kenya borrowing money from its citizens to fund its infrastructure projects. So that's simply what a bond amortization means. And now that you understand what these two conditions mean, let's get to the specifics. The tenor or the time period of this bond is 14 years. The redemption date is the 27th October 2036. The coupon rate is written market determined. The coupon rate is market determined, and I will explain what this means later in the video. The period of sale for this bond started on 26th October 2022 and it will end on 8th November 2022. The value date, and the value date is when your principal amount has been received for crediting at the Central Bank of Kenya, is the 14th of November 2022. So by this date, you should have already wired your money to the Central Bank of Kenya and it's credited in your account. The amount on offer for this bond is 60 billion. So the government is looking for 60 billion to fund its infrastructure projects, and the minimum amount you can invest is 100,000. What does the redemption structure and amortization state? The redemption structure states 4th November 2030, 50% of unencumbered outstanding principal amount, and then 27th October 2036, 100% final redemption of all outstanding amounts. And then the amortization states that no partial redemption will be paid on unencumbered securities on amortization dates. And then any amounts up to 1 million per CDS account at amortization will be redeemed in full except for unencumbered securities. Encumbered securities, so also let's understand the meaning of this word, encumbered securities. Encumbered security is simply a bond that has been used as collateral for a loan. There are people who invest in a bond and use it and go to the bank and use that bond as collateral for a loan. That is simply what an encumbered security means. We often hear real estate investors say after a land search that this plot of land has encumbrances, and so what that means is that piece of land, the said piece of land was used as collateral for a loan, and therefore the title cannot be transferred to a new owner. So what do these terms mean in layman's language? This redemption structure, amortization, what does it simply mean to you as an investor? This is what it simply means. Those who invest 1 million shillings or less, so if you invest 1 million shillings or less, you will get your full principal paid back in 8 years. If you invest 1 million or less, you'll get your full principal amount paid back on 4th November 2030. In a nutshell, this is an 8-year infrastructure bond for anyone who invests between 100,000, because that is the minimum amount you can invest, and 1 million shillings. It's an 8-year infrastructure bond. And so it also means that on 4th November 2030, when you receive your investment amount or principal, you will no longer receive the interests. You'll also no longer receive more interest payments. Now, let us look at practical examples, because this time round, the Wealth Tribe told me that I have to give practical examples. So the practical examples: if you invest 100,000 shillings, if you invest the minimum 100,000 shillings, for example, and then use 20,000 of your 100,000 of your bond as collateral for a loan, the 20,000 will be encumbered. If you won't have paid back your loan by 4th November 2030, only 80,000 will be paid. Only 80,000 will be paid back. Example number 2, if you invest 1,000,000 shillings and then use 20% of your bond as collateral, the 200,000 will be encumbered. If you won't have paid back your loan by 4th November 2030, only 800,000 shillings will be paid back. The 200 shillings will be paid back during the final redemption date in 2036. It will be paid back in 2036. Now, the Wealth Tribe also asked me, is receiving your principal amount early a good thing or a bad thing? It's a good thing. There are two reasons that I'll give you. It's a good thing. It's great for us retail investors. That means us small investors who invest between 100,000 and 1,000,000 shillings, because you get your money back faster. Instead of waiting for 14 years, for the full 14 years, you only wait for 8 years to get your money back. And when you get your money back in 8 years, you can either spend that money, or ideally you can invest in other high yielding investments such as the stock market. And then reason number 2 why it's a great thing for you to get your money back faster is that it lowers your inflation risk. Remember, investing in bonds is not inflation adjusted. What I mean is that if this bond, if for example they give us a coupon rate of 14%, it means you will get paid 14% for the next 8 years or for the next 14 years, and that cannot change. So even if the inflation rises to like 12% or 13%, it's fixed. So bond investments are not inflation adjusted. And the current rising interest rates are a risk to long-term investment. So it's a risk to the rising interest rates is a risk to your investment. We usually say that higher interest rates is equals to lower bond prices. In other words, interest rates are expected to rise in line with rising inflation, so investors are wary of the risk rising interest rates pose to market value of bonds. Rising interest rates affect the market value of bonds, especially those with longer maturities. Being able to cash in part of your principal sooner gives you the ability to invest in other high yielding instruments such as the stock market. What of those who invest more than 1 million? If you invest more than 1 million, you will get half of your principal amount in 8 years. You'll get half of your principal amount on 4th November 2030 and the other half on 27th October 2036. However, if you use 100% of your bond as collateral for a loan, the partial redemption will not apply to you. That means you will not get half of your principal amount on 4th November 2030. Let us look at practical examples. If you invest 1,050,000, then use 150,000 of your bond as collateral for a loan, then the 150,000 will be encumbered. On 4th November 2030, you'll receive 50% of your unencumbered amount, that is 450,000. You'll receive the other 50% on 27th October 2036. If you invest 5 million shillings and then let's say you use 1 million of your bond as collateral for a loan, the 1 million will be unencumbered. On 4th November 2030, you receive 50% of your unencumbered amount. You receive the other 50% after the 14 years, that is on 27th October 2036. Other questions I have been receiving about this November infrastructure bond. Question 1, what does a market determined coupon rate mean? I like to give an example to answer this question. It's like going to the shop. When you want to buy bread, and then you go to the shop and ask the shopkeeper, how much are you going to sell me this bread? And then the shopkeeper asks you, how much money do you want to buy it at? And then so how much money do you want to buy it at? And then your next door neighbor also goes to the same shopkeeper and says, how much are you going to sell me this bread? And the shopkeeper says the same thing, how much do you want to pay for this bread? And then at the end of the day, the shopkeeper is going to do an average of the amount of money that each of you has suggested, and so the average is actually going to be the price of the bond. So that's what a market determined simply means. So in the case of a bond, it's basically that each of us who are going to invest in this bond is going to bid, right? Is going to place a bid during the auction process. And so this is a the market determined, it simply means the coupon rate is determined by the auction process, by the bonds that each of us put through. And so we are going to know the actual coupon rate, the specific coupon rate, after the period of sale, or rather when the Central Bank of Kenya presents the results of the auction process. And this is usually published on the website. This is usually published on the website of the Central Bank of Kenya website. And then another question I've received is, will the bond be reopened in future? Somebody asked, if I am not able to invest now in this bond, will the bond be reopened in future? And the bond prospectus, the document that we checked previously, says that this bond may be reopened in future. But this is usually at the sole discretion of the Central Bank of Kenya. None of us can predict when it's going to be reopened, or if actually it's going to be reopened. And then, but the beautiful thing about it is that even if you don't have the money now and you miss the primary sale, and the primary sale is when a bond is sold by the Central Bank of Kenya, if you miss the primary sale, you can always buy this bond in the secondary market through the Nairobi Securities Exchange by using an approved stockbroker. If you don't already have an account with a stockbroker, I will leave a link in the description box where you can easily set up your account with an approved stockbroker. So you can use this bond, you can use this account with an approved stockbroker to buy the bond, to buy the bond in the secondary market, and number 2, to buy other stocks, to buy other stocks or shares listed on the Nairobi Securities Exchange. And then I've also been asked, why should we invest in this infrastructure bond? Because so many people are talking about it. There are many reasons why you should invest in this infrastructure bond. Number 1, passive income. Every 6 months, you'll be paid interest passively. Number 2, this infrastructure bond pay relatively high returns. Financial analysts predict that we are going to get at least 13.4% as the coupon rate on this bond. And then the interest rate, tax exemption. So the interest rates paid on a bond are exempt from withholding tax. So this is such an awesome thing. You won't pay tax on the interest that you earn from this investment. And then it's a risk-free investment. The government of Kenya has never failed to honor its bond repayments or the interest rate repayments. So it's literally risk-free in that way. And then if you invest in this bond and then 4 years later you feel like, oh my God, I need my money, you can always sell in the secondary market, again using on the Nairobi Securities Exchange, using an approved stockbroker. And finally, you can access a loan using your bond in commercial banks. So if you go to your banker and tell them you invested 100,000 shillings in an infrastructure bond, or any bond actually, you can get a loan. You can get a loan using that bond as collateral. If you have more questions about this specific bond, any question, please leave it in the comment section. I read all the comments and answer. And my name is Agatha from the Wealth Tribe, and as always, this is where we learn how to build wealth together. Please click like and subscribe to this channel, and I'll see you for more.